Now, if I ask you now, this export company, we talked about revenue, we talked about debtors, right? We are taking one by one because we spoke about cut-off assertion at account balance level. But if I tell you the managing director of this company is a corrupted one and he is asking, you know, we haven't hit our budgeted revenue of 900 million. And the managing director is telling the accountant, you know, Puta, you are a young accountant, you know how to cook. Not cook is not a nice word. Managing director says, you know, you are a young qualified accountant, can you help me? You know, some of those provisions can't be reversed. You know, managing director is influencing. You know, it's a nice talk, but later if you say no, you realize that, you know, your other boss comes, CFO comes and say, yesterday you promised managing director to do this, you haven't promised, you haven't given any word. He is very unhappy. Managing director wants you to cook the books, manipulate. If you don't do, you are going to lose the job. And if you are working in such a company, that is the biggest danger, and those risks are called financial statement level risk. And I am writing here what financial statement level risk. I will give you some example. Before that, please write here financial statement level risk means those risks. Remember one word which are, what is that one word? Pervasive. Pervasive, I will explain after writing this. Pervasive, those risks which are pervasive, as a result many assertion can be affected. Many assertion. So I underline the word many assertion can be affected. Now first of all, what is the dictionary meaning of pervasive? Pervasive means many, you know, it's not one, there are a lot of problems. It's a pervasive problem in this company, right? Those risks which are pervasive, as a result, many assertion. Now earlier we knew because of that sales issue, only cut-off assertion can be misstated. But now if managing director is, you know, is a corrupted guy, and who is influencing unethically everybody, now anything in the accounts that he can change, he can influence accountant, assistant accountant or CFO, anybody, and therefore those issues are called financial statement level risk. So I am writing in red color some example for financial statement risk, right? Please write this example. One is, if there is an issue with management honesty, that's why I use the word corrupted in simple language, but in auditing language it's called integrity, management integrity. If there is an issue with management integrity, disaster, that's the, you know, biggest thing. And then management can bypass control, that in auditing we use. Now let's say there is a credit term, managing director says, no, my son's company credit limit is, forget any amount you can sell to my son. So you bypass, the bypass means management override control. And also you find that in this company there are people who are not qualified accountant. Managing director doesn't want to recruit any qualified accountant, let's say, which means you have a question about management competence. Competence means they are skill, qualification, skill, experience. If they don't have experience, how are they going to account for difficult balances like financial instrument derivatives? So it can be misstated. Right. Another example, if I want to give going concern, right, it can affect many assertions. Now these risks are called financial statement level risk. Right, now you have learned that as well. Now in this lecture, before I finish, I want to connect this to a much bigger concept to conclude this, right? That is, now I have drawn a big circle and you should ask me, what is this circle? And remember, in a little while I am going to introduce to you something very big, and that is internal control framework of a company should consist of 5 things, right? And there, one is here. I am putting number 1 here, 1. And then I want you to guess what are these. If this entire circle is 1, and then the next one is out of that circle, and there is a process here called RMM, and that I am putting number 2. Then what is 2? And then I can write number 3 here, right? And then I can also write, now see, in every company the numbers won't just come, no. Now either there is accounting package or a ERP system. Let's say this box is that. So then I put number 4 in this box. And then where is number 5? Okay, number 5. For me to write number 5, what I am doing is, I am going to draw another circle around this, all these 3 circles, and that is like protecting or checking all these things, right? So that is, if there is a circle like this which goes all around, right, and I can put here number 5. And what are these 5? And remember, this is, we are getting to another important concept. Please write. Now if you look at chapter 2 of your syllabus, talks about internal control framework in a company. You know, in every company, now actually we are looking in this up to now in my explanation, more than the auditor, you are looking company. If you take risk of material misstatement, it's not auditor's problem. Before you audit, you understand, right, the possibility that the financial statements can be misstated due to an inherent risk or control risk. That gives us the definition of RoMM. I told you I am going to give the full definition of RoMM here, and I said that is note number 3. So please write. Now RoMM definition is what? RoMM means, I hope you will go back to your note page, right? The risk that, so let me write, see, these are notes that I will erase, therefore please quickly write. RoMM means, the full word RoMM, right? The risk that financial statements can be misstated prior to the audit. Now the key word to underline is that prior to the audit. Now why we say prior to the audit? Now that is where before an auditor starts the audit, auditor has to assess what is the inherent risk in revenue recognition. Inherent risk is high. Is there a control, right? So IR is high. Is there a control? Let's say control is failing, so control risk also high, which means both inherent and control risk is high. If both risks are high, auditor has to make sure, auditor will detect misstatement. So I will explain that point also to you in a little while, but now I covered this RoMM part. What I was explaining to you previously, let me to get back to my previous point. In this diagram, the 5 things that I wanted to tell you, in every company, you know, they will make sure any company will have these 3, you know, this is an international framework that you are going to learn. This is called COSO framework. There are 3 things as the objective of every company, and there are 5 things. I told you there are 5 things in my diagram already. I haven't written the name, and this is applicable. Let's say this is a company, they have several branches. Now let's say this is a company like John Keel's, they have hotel sector, they have plantation, various other business units, right, travel agents. Now this framework is applicable to all. Every company, they want to ensure, every company is doing operation, they have to ensure they are effective. So let me to write, use another color. Effective and efficient. They are effective and efficient. Efficient means cost efficient, right? Effective means they are achieving the targets in their operation. If you take a tour operation, you know, they are very efficient and their customers are happy, that's operation. And then every company has to make sure the reports they are giving. Here we are talking about financial statement, therefore reliability of reporting, reliability of financial statements, the second objective. Third objective is compliance with laws and regulation. If you take a banks, they have to comply with law, not only bank, every company. So remember, if you are talking about a control framework that can protect the company, what matters to us is not this reconciliation. If you look at most of the corporate failures around the world, like Enron, WorldCom, Satyam, all of that, and in Sri Lanka, the Golden Key, Selinco Group, all of this, Premuka, CIFL, in most companies, was it due to a reconciliation issue, or was it due to something bigger that connects with the leadership and board, right? That is the issue, and that is circle 1, and that is a big concept that you are learning, and I will write that here. That is called control environment. So this is an extremely important examinable topic. Control environment. Another word, whenever there is a control environment, we call tone at the top, which means the top people are doing the right thing and they are always ethical, and if they are ethical, the chances that numbers are right is high. So therefore, in the internal control framework, the first thing that comes is control environment. And this is very much examinable, and I would like to give you this, remember this word, if somebody asks, okay, what does control environment means? What should come to your mind? Wow, if you are working for a company where all board of directors are very much honest and they pay customers on time, they produce quality products in the accounts, you know, they never cheat auditors, very good, and in terms of governance they are very active, they recruit only high qualified accountants, HR policies are brilliant, there are segregation of duties, authority responsibility defined, right? The management is very careful in taking risks, that is their philosophy. I am using now several words, let me to put all this in one term that you can remember, and that is I call champion, right? Now this will be very easy because all the students, you know, sometimes while you are given the opportunity to use open book in an online exam, usually this is not an open book examination usually, right? Now champion means what control environment? Now I mentioned to you it's about integrity and ethics, the whether company is honest, see, integrity and ethical values of business leaders, and that is one. And then I mentioned to you this company should have qualified people. Now please write that word. To have qualified people we call commitment to competence. Now this is there in your study text. This with page numbers I will show you. And also, if company has a very good culture, right, a very good set of accounts, and that is a result of people in the company, and that is we call HR, right, HR policies and procedures, right. And then there is M here, that M refers to management philosophy. I use this word, management philosophy and operating style. So don't worry that you will not understand this full detail now, but if you go to my video, there is a separate case study explanation about control environment, you can understand. But then why I am doing now also I am explaining to you. Management philosophy and operating style means company is really careful when it comes to risk taking. If there is a company, they always change auditors, they are very aggressive, they invest and make losses, the management philosophy and operating style is really negative. So please write other P, that is called participation. Now let me write that P here, otherwise I can't write the full word. P, participation by those charged with governance. Now when you watch this video, you will see why I write TCWG. Now these are famous words in auditing, right? Those charged with governance, please write the full word. Participation by those charged with governance means It refers to corporate governance. So control environment as governance. Participation means whether this company has non-executive directors who are independent from management. Independent non-executive directors, are they active? Are they attending to meeting and challenging the management? And that is called participation by those charged with management. Now out of Champio, right? So what is A? Now A refers to assignment. Let me again write that A here. A refers to, please write, assignment. Assignment of authority and responsibility. Right? Assignment of authority. Now we know the authority for accounts given to CFO, and CFO has delegated assignment of authority and responsibility. Now we know there is a finance director, overall responsibility, right, and then the authority has been given to CFO, delegated. Now finance director will delegate. Company has very clearly defined this, right, and that all duties, responsibilities are defined in organization structure, which is very clear, and duties are segregated. There is organization structure. If you take finance organization structure, it comes with finance director, then CFO, then there is a senior accountant, then there are accountants for different categories, PP and so on. So likewise, see, now I took 5 minutes just trying to give you a picture of control environment. But remember, in the exam in MCQ, if examiner asks you, what is the control environment? The answer that you have to give. Now, I have only explained to you one, and that is this circle, control environment. If they ask in MCQ, what is control environment? Remember, control environment refers to, right, control environment, I said one word is thrown at the top. In addition, control environment refers to those, right? I am putting AAA to introduce control environment, attitude, awareness and action of those of management and the board regarding internal controls and their importance. Right? Now that is, now I will read it again. What is control environment? Control environment refers to AAA. Attitude, awareness and actions of the board and management regarding all these internal controls, reconciliation, authorization, all of this, the internal controls, and that is called control. I am sure still you don't understand, some of you. If I tell you, you are working for a company where control environment is stronger, their attitude towards accountants very high. They take always qualified people, right? They give them software is upgraded and change and all the controls they are introducing, right? There is a positive attitude. Their awareness about accounting and internal controls are very high. When I say they are the even board of directors, right? Remember, control environment, something relating to board and senior management. Their attitude, awareness, and if anybody violate controls, even a CEO who is not following company's control, the guy is going to be sacked. And that is control environment. So which means the board and management consider in very simple term internal controls are important. Let me to tell that definition again. Control environment means, right, the governance and the management, attitude, awareness and actions regarding the internal controls and their importance. Now you learn that. Then when there is a good tone at the top, if your main objective is this, let's say now we are talking about financial statement which is in the middle, and secondly whether company has a process of risk assessment, right, risk assessment, R-I-S-K, risk, and in my diagram this process is the called risk assessment. Now if you remember my example, that company has identified revenue recognition is a complex balance. If the same company has investment property or financial instrument, the CFO knows these are also my risk, and CFO will ensure controls are in place, and that risk assessment I put number 2 here, that is risk assessment. And when there are risks, as I told you, company will implement control activities, and this circle is control activities here. It's already written. And then I said in a company this information has to come out from a reliable information system. It's very important that we ensure that financial statements are coming out from a reliable information system. So this box, I put number 4 here, information system. Remember, when we talk about IT system, there is a separate, in chapter 3 you will learn that if system, now if this system has program issue, access rights are not restricted, there are errors, right, all of this. Now if there are such issues, then we can't rely on this information system. When we talked about information system, we are talking about 2 golden concepts. One is ITGC, IT general control, plus IT application control, right? Now IT general control means there are no programming errors, nobody can unauthorizedly access database and delete. Now when system is protected, then only we can rely on system based control. For example, you know, in some companies, when customer exceeds the credit limit, system blocks it, but the programmer goes and manipulate this logic. So that programmer manipulation is ITGC. As a result, my credit limit check has gone for a sec, it doesn't work. So these topics we will discuss in chapter 2 in detail, information system. But remember that without information system, we can't talk about internal control. Information system is how financial statements are produced, and communication. The last one is called monitoring. Now what is monitoring? The idea is, remember I put an overall circle covering everything, and that circle is monitoring. Monitoring means somebody in the organization is checking whether these all controls like control environment, the risk assessment, and then control activities, information system, all these are working properly and giving assurance to board, and that is monitoring. Remember, usually in companies monitoring is done by internal audit, and therefore here with the last circle is monitoring, right? So monitoring is there, means internal audit is checking whether these controls, the reconciliations are working and so on. And if I put another one more circle after this, and that is probably external auditing. Now you can see, I mentioned to you at the start of this lecture, right, this is going to be the most important session. This connects, the heart of auditing connects to all other sub-sessions that I am doing, and I said this is going to be a bigger part of your syllabus. You will ask, okay, what did I learn? You learned the heart of auditing, all these concepts, right, starting from what is RoMM, risk of material missystem, all this, the MCQs, case studies, all of that can come, right, RoMM. And then what is a misstatement, right, and then what is materiality, and then what is assertion, and then what is inherent risk and control risk, and then what are the 5 components of internal controls, and then most powerful concept, control environment. Therefore, before I conclude, right, I said this whole analysis talks about 2 big parts of, okay, let me write on the top whatever I explained to you. If you remember my example of sales, we spoke about inherent risk. We said inherent risk is high, and we talk about that reconciliation as a control risk. Let's say control risk also high, which means overall RoMM is high, and that means we know RoMM is something auditor will assess prior to the audit. Prior to the audit, auditor knows that the sales may be misstated, therefore overall audit risk has another component, and using that component only auditor can reduce the overall risk, and that component is called detection risk. The idea in this company, if you take my sales cutoff example, that there is a risk of sales cutoff. Sales can go wrong, it is complicated, company's reconciliation is not working, both risks are high. As a result, auditor should plan auditor's substantive testing, which means those testing conducted by auditor to detect misstatement, right? Auditor should be able to detect this misstatement. Therefore, if there is MCQ given when IR and CR both are high, auditor's detection risk should be low, then only auditor can reduce the overall audit risk. Then you will ask me, what is audit risk? Overall audit risk means, remember I said auditor is going to give an opinion. The audit risk there means the risk that auditor gives a wrong opinion when the financial statements are materially misstated. So that is called audit risk. Now you also understand at the end I have covered the audit risk model that has IR, CR and DR, and remember DR is something controlled by the auditor, right? And then the last point that I want to make in this lecture, which is very important, sharp point, and remember that point. What auditor is actually doing in an audit? Say RIDMA PLC case study you will get. Auditors, through auditors understanding, auditor understood there is a possibility of sales cutoff. Now, how many sales invoices that I have to check every month whether the shipping documents are tallying or not is hassle. Therefore, when there is a risk, always auditor's first choice is to see whether company has a control. Remember my circle here, right? If company has a control, the first thing auditor will check, test is company's control, test of control, that is called test of control. If company has a control to detect misstatement, I am going to see whether company is detecting misstatement, that is in auditing called test of control, right? And then if control is not working, then auditor will have to perform auditor's own procedures to detect. And that is the big point. So therefore, in your chapter 7, you are talking about audit evidence. Audit evidence is usually gathered through two big, audit evidence process, which we will cover in chapter 7, is all about, doing an audit is all about, first you go and figure out where is the risk through RAP. RAP is called risk assessment procedure. Like we did here, sales cutoff, we identify the risk. If there is a risk, decide how are you going to do, how are you going to detect it before you give in the opinion, what are you going to do after risk assessment procedure. Auditor will do what is FAP. Please write FAP is further audit procedures. Further audit procedures, right? Now that sales cutoff risk was identified, auditor's further audit procedure is either to test the reconciliation, which we call test of control, or auditor to perform auditor's own substantive testing. Now even if you don't understand my last explanation, be happy that you are going to learn this. Only learn that audit evidence has two parts. One is to know where are the risks, the other one is to know what are we going to do with the risk. Am I happy with company's control so I can test the reconciliation? If I am unhappy, I am going to compare all these sales, not all, audit is doing on a sample basis, that we will learn in chapter 1, why audit is only providing a reasonable assurance. If I am not happy with company's control, I will do reconciliation by myself by picking a sample of, now you are doing cutoff testing as substantive, which means you will select a sample of sales invoices and then you will go to the contract and see whether this is a FOB contract, and then for your sample you will check the bill of lading. Bill of lading, invoice 31st March, bill of lading is April, you are saying this revenue recognition is wrong. So I am sure this session you may want to watch again because this is foundational. The list of concepts you learn